Yeah, I think the first one is overregulation mixed with cost. It's becoming increasingly a bigger concern. I mean, if we look at the global financial crisis, certainly there was the situation of underregulation, but that pendulum, in our view, has kind of swung from overregulation past the kind of midpoint to overregulation. So I think that is, and which has really caused a lot of cost for our member firms going forward, and you've kind of seen a lot of firms withdrawing from certain markets because it's just too expensive to do business there, or for particular products for that matter. The second one is increasingly cyber. If you look at the fintech developments, but just in general, there's a lot of connectivity through the internet, otherwise in the technology space, and cybersecurity is really becoming the top of banks' concerns. They're under constant attack from outside. They're also under the possibility of even firms breaking into what are really closed networks. I mean, we've seen what happened with Bangladesh and SWIFT. So that is a very, very big concern, and it's growing as people get replaced by machines. We're going to even see this to be a bigger concern going forward. And it's also a concern because you have countries like China recently, which has passed a cybersecurity law, which on the face of it is focused on cybersecurity, but a big part of that seems to be focused on pushing firms that deal with China to use Chinese-made software and IT systems, and not to really offshore, sensitive information. So again, that's not really a cyber concern. That's something really related to China's own economic policy, and we're concerned other countries may follow that lead. The last thing I'd say is AML KYC. It's increasingly an unintended consequence of tightening regulation around that for very good reasons, dealing with terrorism, fundings for crime-related activities. But what we're finding is it means that big swaths of the population are essentially being excluded from financial services. But even in a market like capital markets, which is for professional investors, there's a lot of debanking going on, and a lot of small, medium enterprises or asset managers are not able to actually trade with counterparties, and that's really in the Asian region really impacting capital market development. Already a lot has happened in this. So if you look at Asia in particular, many of the large banks, the large global banks, have really withdrawn from various countries, various products, and they're really starting to focus on those products which are the most profitable for them. The whole idea of a full-service banking firm that's going to deal with all the products across the capital markets in all the countries is pretty much a dead concept. There's only a few really around. Basically, firms to remain profitable are really picking their niches, where they're top 1, 2, 3, 4, 5 in those markets. If they're not in that top 5 or so, they're pretty much getting out of that business because it's not sustainable. So I think what regulators need to think about is, well, it's very important, and what we've seen from the global financial crisis, to deal with financial stability. It's also very important to have a range of counterparties in various different products in various different countries to develop deep liquid capital markets. If you don't do that, then you're not going to have those deep liquid capital markets develop in Asia, and then you're going to have the same issue that we've had historically here, which is an over-reliance on bank lending. And we only have to look back to the crisis in the 90s to realize that an over-reliance on bank lending can have very significant impacts on the economy. So let's not just fight the last crisis, let's look at a more holistic view, make sure that you're not overburdening firms that are preventing them from effectively playing in your markets, because you want that competition to develop the capital markets going forward. I definitely think that a review needs to happen, and to a certain extent it already is happening. You have at the Basel level a commitment to review the cumulative impact of all the regulation that they've done. The same at IOSCO from the regulator side. So it's going on, but that really needs to happen because, as you say, this regulation came in very quickly and had to come in very quickly because of the global financial crisis. I mean, regulators were looking over the edge and the precipice and faced with the biggest crisis they had, at least since the Depression. And because of that, they had to move very, very quickly and bring things in a way that they probably wouldn't otherwise have done with proper cost-benefit analysis. That really kind of went out the window because they didn't have the time to do that. They had to move very quickly. But now that they've done that and they've layered regulation on top of regulation, and also pieces of regulation that they may not even realize have an impact on each other, that really needs to kind of go on to develop the market going forward. Otherwise, you have that pendulum of under-regulation to over-regulation, which is really going to kill the development of the markets within Asia. Yeah, I definitely think that Asia needs to think about how do we develop capital markets within this region. The way that that's traditionally been done is that every country does their own thing, creates their own sort of national airline infrastructure type vehicles whereby it's done in isolation and it hasn't been done from a point of view of looking about cross-border. The net effect of that has been trapping capital within particular countries, meaning that their markets remain underdeveloped, and if the capital can escape outside of it, it flows off into the developed world, whether that's Europe or the United States. So you've got Asia, which is a developing region, essentially funding the developed world. So really, they need to kind of look at creating cross-border regimes to try to keep that capital within the region, and for each of the countries to be essentially complementary to each other, and capital flowing across borders within this region and developing a big sustainable capital market that can go cross-border. There are some initiatives that are at work. The Asian Regional Funds Passporting Scheme is one. ASEAN CIS is a smaller version of that, which allows mutual funds to sell across borders. These are the kind of things that they need to think about. Otherwise, their markets are really going to end up being less developed than Europe and the United States. Well, I think that fintech is transforming the whole industry, and it's happening quite rapidly. We don't know where that's going to go, but what we have noticed is that the traditional types of skills that were required, within banks or regulators, sort of that market knowledge, old school type, not really technology heavy, are being replaced by younger, nimbler individuals who really kind of come from a tech background, because individuals are actually leaving the industry because technology is replacing them, and I think that trend will continue. So while that's happening within the firms, it also means that regulators need to keep up with that. So we're seeing regulators having things like sandboxes and bigger emphasis on that. But whether they have the skills to really fully understand how that works still remains to be seen. Quite often we see regulators in the region taking sort of negative views about technological developments like HFT, high frequency trading. In my personal opinion, you can't stop technology and the development of technology. All you can do is regulate it appropriately. So we had equities being traded on open pits, and then we moved to electronic trading, and people at that time were concerned about that. Now we're moving to something which means people are trading at milliseconds. That reality has to kind of permeate down to the regulators to the point where they understand that that's not going to change. We can't go back to the point where retail can be actually competing as day traders with high frequency trading systems. It's just not going to happen. And really they just need to understand that the market's moved on and they need to regulate appropriately. The new generations, not only that they're not used to it, they actually don't trust it. So the old way of doing business, where you went in to see your bank manager and you trusted him or her to kind of give you advice and tell you what to invest in. People don't trust that anymore. There's no longer that trust of authority, whether in banking or otherwise. What people trust is their phone and looking on their phone and getting the information they need and being able to make actually better informed decisions. So I think that is the opportunity, and I think that banks, asset managers, those that recognize the fact that most business in this industry in financial services is going to be transacted through a phone or some sort of device like that going forward, and the ones that can kind of make that transformation as fast as possible and get to that market. And they're not just young, they're pretty much everyone is rapidly moving there. They're going to be the successful ones going forward.